next two guests have some profound insights and market analysis on the key trends, disruptions, and opportunities shaping vehicle logistics right now and in the years to come. But with that, I want to hand over to my first speaker, Mr. Brandon Mason, Senior Manager, Lead Analyst of Global Market Intelligence at Eaton, to share some of his thoughts on the macro trends. Brandon.
Thanks, Rich. Good morning, folks. Also, credit to Chris and Steve. I think that was a great intro session. So I'm going to attempt to take the next 15 minutes or so to sort of qualify and quantify some of the major issues we have going on around the world and in North America. No easy task, as it ever is with some of the things that we're facing, but I'll do my best and look forward to the conversation in the panel with Sergio immediately after. So let's jump right into it. I want to start off with just what's kind of going on around the world. Last year, the big discussion was primarily around semiconductors and the shortage, which impacted our industry by about 10 million units. The good news is we're in much better shape today. It's slowly improving, but we've had some other things that have sort of crept up. We talked about the lockdowns that are just starting to lift in China, but that's had a significant impact. And then obviously, over the last several months, the impact on the Russian invasion of Ukraine. So if you combine all of those things together, year to date, we're looking at a global impact of about 3.1 million units combined for all of those things. Now, the good news is, again, as I mentioned, that the China lockdowns starting to lift, so that's good news. Time will tell if we have more lockdowns or as we get into the winter season in some of the markets, if that will impact production. The Russia-Ukraine impact, it's important to note there, we've got about 200,000 units of impact year to date. That's strictly related to supply chain issues in that market. So most of you folks probably know that there are a lot of wire harness production that was going on in Western Ukraine that was feeding into Europe. So that's where that impact has come from. That has largely been addressed, not to say that other things couldn't pop up, but I don't think that that's going to get too much higher. So good news there. On the chip impact, I think year to date, we're at about 1.7 million units. So again, if we sort of extrapolate that out, even though it's improving, going to be in much better shape than we were last year. So that's really the good news. Now to some of the bad news. We're going to talk today a little bit about inflation and interest rates and things like that. But there's starting to be some big cracks in consumer confidence. If you look at the consumer price index, it was up 8.2% last month, year over year. That's about a 40-year high. The good news is it's ticked down a little bit, but that's because interest rates are going up. So we're going to talk about that a little bit. If you look at the forecast, for this year, S&P, formerly IHS, is expecting a slight year-over-year increase on the light vehicle side, but that was, after a constrained year last year. So I think we keep waiting over the last 2 years. Like, when are we going to have that breakout gangbuster year? We're still waiting for it. And next year will bring its own set of challenges, which we'll get into as well. On the commercial vehicle side of the business, obviously China is the largest market in the world because of those shutdowns and the risk of a recession there as well. We're going to see a lower number on the commercial vehicle side. For you carriers here in the States, the good news is Class 8 production is up. Should be up about 15% this year. Although I'm sure there's added concerns about what you're actually going to pay for those vehicles when you finally get them, and then you got to find drivers to put inside those vehicles. So I can appreciate that there's some challenges there as well. So I would say, if we look towards the second half of this year, production is supposed to be a little bit higher than the first half of the year, again, assuming some of those supply chain issues that we're dealing with right now start to gradually improve, but we obviously run the risk of others creeping up. So that's a quick look around the world. So let's get into US specifically. And I'm going to spend a little bit of time on these two slides because I think it's really important. So the chart on the left is the consumer price index, which I alluded to earlier. So this is inflation, right? And this is the big thing that we're dealing with right now in our markets. So if you look at the April number, it's 8.2%. So that includes everything. Some folks like to take out the cost of energy and food. If you do that, it goes down to about 6.2%, still 40-year high. And this started creeping up over the last year or so. And so the question is, well, what caused this level of inflation to just skyrocket relatively unchecked? Well, obviously labor shortages have been a big part of that. So we all know what happened as we came out of the pandemic in 2020. You had a lot of folks that retired. You had a lot of folks that upskilled their jobs. You had a lot of folks that wanted to have positions that worked from home. And obviously in the manufacturing sector, that's kind of hard to do, right? You kind of have to be at the factory building vehicles. And so the manufacturing sector actually probably has one of the highest job shortages out there right now. So there's a huge gap between supply and demand on that side. Another important point, obviously, is immigration. You know, the U.S. has very tight immigration policies right now. There's not enough folks to come in and fill some of those positions. So that's been a big driver of the inflation. Obviously, energy costs have gone up with what's going on in Ukraine right now, right? A lot of the oil that Russia produces has been embargoed in a lot of parts of the country, the world, excuse me. So that's driven up prices. OPEC hasn't been able to increase production of oil quickly enough. They might not be able to, or they might not be willing to, whichever side you decide to pick there. That's driving up costs as well. And then we talked about the other supply chain issues that are going on around the world. And so you might ask yourself, well, shoot, if we're talking about record high inflation, why are we increasing interest rates? Because isn't that going to make things more expensive in the near term? And the short answer is yes. But if you think about the Federal Reserve and what their goal is, right? Most folks know this, but there's two primary goals. One is to keep inflation at or below 2% and to have full employment. And you can see the dotted line there on the left. That's the 2% number. So you can see over the last decade or so, since we came out of the Great Recession, they've largely been able to achieve that. But because of the reasons I just mentioned now, they've been forced to act. Thank you. They've been forced to act. And so some would argue, well, why didn't you guys do this last spring when we started to see these interest rates or the inflation levels start to creep up? Well, a lot of people thought at the time it was going to be a short-term thing, right? Oh, once we get the supply chain issues figured out, once more people come back to work, it'll sort itself out. Long story short, it didn't, right? And now with the Russia-Ukraine conflict going on, that's further exacerbated the issue. So the biggest tool that the Fed has in their toolbox is manipulating the effective federal funds rate, which we know sets mortgage rates, auto loan interest rates, things like that. So what they've said is, and you can see that it started to creep back up before we got to COVID, because again, we were having a robust economy, and so you need to start to gradually increase the interest rates. Plummeted back down to 0% over the last 2 years because of COVID. Now they're ramping it back up. They're hoping that since we can't do a lot about the supply of some of these issues, labor, energy, et cetera, we need to lower demand to kind of temper this inflation. And so that's where we're at. And so the Fed has come out and said, hey, we're going to continue to raise interest rates, and they're going to attempt to initiate what's called a soft landing next year, which is do all of this without getting us into a recession. That's going to be a really difficult thing to do. In fact, I think it's only been done one time in history when the Fed's attempted to do that. We've seen it immediately, right? So if you look right now, the effective federal funds at 0.8%. They've said they're going to raise interest rates another 2 to 3 times this year. The chart, so if you go to the chart on the right and then the table up there, the FOMC median forecast, that is what people think on average the interest rates are going to be at the end of each of the next 3 years. So by the end of this year, they're predicting interest rates of 1.9%. That's going to increase to 2.8% next year, and then hopefully stabilization, leveling off at 2.8% in 2024 as well. So we will see. A lot of this depends on the ability, again, to do that soft landing, or if we are in a recession, and most folks think that'll happen sometime in the second half of next year, how bad is that recession? Is it a relatively mild one, which gives the industry and the economy a chance to recover some of the supply chain issues, normalize the labor situation, and then we're off and running again? Or is it going to be a harder landing, and it's going to force the Fed to kind of lower those interest rates again? So it's a very interesting dynamic that we have going on right here, but obviously we know something needs to change because it's not sustainable, the inflation levels that we're seeing right now. So this sort of sets up our discussion now as we get into the more industry-specific indicators. I think Chris and Steve talked about a little bit on their panel as well. So things like new normal, and we'll get to that when we talk about inventory. Chart on the left are vehicle incentives, which obviously, since we've had no supply over the last couple of years, they've plummeted. And I think we all know what's happened with transaction prices. They've skyrocketed, 10 to 15% in just the last year. average transaction price hovering right now around $45,000, $46,000. Again, some initial glimmers of, I would say it's probably too early to start claiming victory yet, but with some of these rate hikes, again, consumer price index dropped a little bit from the previous month, and you can see the average transaction price dropped just a little bit in March compared to February. So again, too early to start declaring victory, but those might be the early signs that we're seeing that we'll start to see some normalization. But obviously we know that at the end of the day, none of this matters until we right-size our inventory situation. So here is the current inventory situation. As we sit here today, we're at about 1.1 million units in the US. That's largely been the case, for much of the last year. And again, when we talk about new normal, I don't think we're going to go back to a situation where we had, 3.5, 3.6 million units of inventory, because one, those don't command as high of transaction prices. You're offering more incentives. It kind of waters down the market a little bit. So I do think that consumer expectations, whether they like it or not, are going to have to change, as Chris and Steve were saying. Right now, we're at 25-day supply. That's not great. And, even though consumer confidence is relatively low to this point, that demand and some of those lingering supply chain issues have not allowed us to increase inventory. So again, what is the new normal? Do we go to a 45-day supply, a 60-day supply? I think some of that's going to kind of get sorted out here over the next 1 to 2 years in terms of what the industry is able to do. There's also some discussion around electric vehicles, and will electric vehicles have the same level of inventory as ICE vehicles? I think there's a good point to be had there. One, capacity of those vehicles is generally less, but if they are received well by consumers, I think it's conceivable to say that there would be less inventory of electric vehicles in terms of day supply versus ICE. So again, we shall see on this front. So what does that mean for sales? So here is the latest S&P sales outlook. Again, we were hoping that we were going to have a really good recovery year this year, but last month's sales came in pretty disappointing. 12.7 million units SAAR. So S&P is actually forecasting just a slight increase this year. Again, consumer confidence is at an 11-year low or something like that right now. I don't anticipate with, again, the moves that we talked about with the Fed and things like that, that consumer confidence is going to get any higher here over the coming months. We do think there'll be a little bit of a rebound next year, but I want to stress this. There's a lot of risk if you look at those gray bars there. Again, we talked about we're waiting to have this breakout year. We had all this pent-up demand over the last couple of years. Consumers really wanted to buy new vehicles. We just couldn't provide them with those vehicles. And they've been waiting and waiting and waiting. Some of that's going to go away. Inevitably, especially if we land in a recession, you're going to have unemployment numbers go up. Again, we talked about inflation and interest rates, more expensive to purchase things. My fiance and I are building a house right now. Not a good time to build a house right now, guys. Okay, 30-year fixed rates, ouch. But I have to remind her that it's only going to get worse over the next year, so we should probably try and lock it in now. So always fun discussions on the front. But again, I would say there's a lot of risk built into those numbers. I still think we're going to have an uptick next year despite concerns around a recession, but it's a question of how much of an uptick will we actually have. Okay, and then on the production front, so it's a little bit of a different story, and we've been talking about this the last few times that I've spoken at these events. We have to recover that inventory to some level. Again, we don't know what it's going to be, but there's a lot of upside that's going to present itself on the production side of the business. We talked about BEV investments, so we've got new battery electric vehicle plants coming online. We've got retooling of other facilities, expansion of facilities. So the good news is on the production side, we're going to have to replenish that inventory. Obviously, it's kind of a fine walk because OEMs don't want to indulge on that front and then us have a recession and then we've got a glut of vehicles or an inability to move some of those vehicles, which we'll talk about here over the next few days. But I do think there's less risk on the production side of the business, again, assuming that we get some of these supply chain issues sort of sorted out over the next 1 to 2 years, or hopefully not beyond, but that we're sort of able to mitigate some of those. So that's the production outlook, a little bit more rosy than the sales outlook. So I just want to leave you with a couple points here. Again, we talked about the semiconductor issues. They're going to continue to persist, but everything is trending in the right direction as of now. The record high, inflation that we're seeing right now is likely to lead to a recession. Let's call it the next 12 to 18 months. I think most folks would say the second half of next year is really where we see the highest likelihood of that happening. Just kind of introduce a couple other topics that we can talk about when we sit down here in a few minutes. The BEV and battery supply, I think there is growing concern that we're going to run into some issues on that front as well. And you've already seen OEMs and suppliers alike sort of scrambling to figure out, like, what is that supply chain going to be like, and how do we procure those resources now, because the inflection point is coming. If you look at S&P's forecast from last year at this time out to like 2030, global BEV penetration was forecasted at like 23% of the market. If you look at it now for 2030, it's 34% of the market, which adds even more strain. So that's driven by a combination of obviously increased regulatory targets. That's the OEM commitments and investments in electric vehicles. That's changing over those facilities from ICE to BEV. All those things are driving up that. So there's going to be a real issue. And I would say 2026, 2027 is probably that inflection point where you see a fundamental shift over to electric vehicles. So it's best that the industry starts to get ahead of that now. And I would say that they're doing a good job for the time being. And then the last piece, we've seen a little bit of this already on the supplier side of the business. But as that inflection point nears, the day of reckoning is coming. And I think most folks recognize that we will see accelerated consolidation and M&A activity on both the OE and supplier side of the business. So just some points to leave you with. Look forward to hearing Sergio's comments, and then we'll get back to you when we set up on the stage together. Thank you so much.
Thank you very much, Brandon, and hopefully you're not all too depressed. But here to lift our spirits, I'm going to welcome Sergio Gutierrez, President and CEO of RPM, to share some further insights and analysis. Sergio, over to you.
Thank you. All right. Thank you. So we took the liberty to put together a deep survey that we sent out to the community at large, and we got a pretty strong response. More than 1,000 people participated. This survey was sent out to the shippers, to OEMs, to LSPs or carriers, and everybody that has a little role or a big role in the finished vehicle logistics. So again, what we're sharing here today with you guys is not our personal view, but it really represents what most of us think. So with that said, and I hope this finally follows me, good. So out of these 1,000 participants, we summarize that there's 4 major concerns happening and impacting the finished vehicle logistics segment nowadays, starting with the market uncertainty. So overall, all the respondent believes that the market uncertainty is really the worst of all the challenges that we are facing. The not knowing what's going to happen is what is impeding everybody to move forward, is what is causing investment to slow down, is what is causing every shipper and also every carrier to take more conscious decisions as far as what are they going to do with their equipment and how to send it, how to apply it, where to send it, and where not to do it. And this concern is really creating a lot of tension in the system. The geopolitical risks with the things that are happening globally, of course, they play a big role, but at least for the community, it doesn't seem to be really the main driver of concern. So volatility continues to be the major challenge. And as Chris and then Mason and Steve shared, it's very hard to plan when in reality, nobody really knows what we are going to be able to deliver the next day. With this volatility, there's definitely a growing need for speed and agility. And it's very interesting to us as service providers that not knowing what to expect, we all are trying sometimes to go back to normal, going back to old forecast, going back to big models of production, when in reality, nobody knows. Not even the OEMs have the crystal ball with a certain answer, with certainty. So it's very important, and this is kind of what we all as a community shared, that we remain flexible and agile. Speed is crucial. And the concept of speed applied to finished vehicle logistics is always been challenged, but nowadays is worse than ever, I will say. But it's very interesting because it seems like sometimes speed gets kind of placed on hold until the very last minute, and then we all collectively try to solve all the other ups and downs that happen in between production and delivery at the very last minute when shipping a car. As a service provider, I can speak for some of you guys, or on behalf of some of you guys, I guess we all recognize that catching up at the very last minute is probably one of the toughest challenges that we all have to deal with. So that's kind of the main one. Rising fuel cost, of course, still is a major concern. And as we discussed just a few weeks ago in Europe, there's nothing we can do about it in a direct way. What we are now doing as industry players is that we unfortunately have fallen for this model of, okay, I cannot control the fuel cost, so I'm just going to pass it back to the shipper and he's going to have to absorb it, or there's no way I'm going to be able to move your product. In reality is that it looks like while we're not able to control the fuel prices, we definitely are responsible collectively on how to deal with. We need to focus much more on reducing empty kilometers and empty mileage. We need to focus intentionally in sharing capacity. We need to focus in a more effective way into bringing a bigger and more visible network that we can all benefit from. But if we don't do these things and we just expect that fuel prices are going to be just tossed or passed back to the OEM and they will have to pay, I think that we collectively are not doing a great job on being great partners of them. Definitely, they are paying for it. They're paying us to move the product. But it's our responsibility as well to find better solutions to reduce that cost and try to minimize it, because nobody can control it. Driver shortages, yes, it's been discussed tremendously. And at the beginning of all this pandemic event, and then when kind of the recovery started to happen, we all were hearing about driver shortages and that there was no drivers, and drivers were pretty much jumping out of finished vehicle logistics into freight, for example. The reality is that the drivers, as Steve said, or he was asking earlier today, they didn't disappear. I mean, they want to get things in motion. It's no longer enough or good enough just to be paid, even if the cargo is not moving. The drivers want to drive. The drivers want to move. The drivers have a plan, and they would like to get to the location, pick up the load, go to point A, go to point B, and build the plan that they have. So every time that we cannot fulfill that desire, yes, they're getting desperate, and they're just moving to a different industry that keep them in motion. So this presents one of the toughest challenges. Reducing inefficiencies and maximizing driver or driving time is what we all need to focus on. And again, as players in the industry, we all are equally responsible for keeping the drivers engaged with our community. Why am I saying this? It is very common that nowadays we get the call, we all get the call, and we all get invited to bring capacity last minute, and we all do whatever we can to make it happen. And then the drivers gets there, and they wait for hours and hours, days. And then suddenly, well, there's nothing to be shipped today. Thank you. I feel that we are taking this through a very myopic lenses, because, again, it's not about paying the driver to go home. That driver already had a plan. That driver already had a logistics path to follow. So if that cannot happen, then that capacity and that driver per se is just wasted. And it's a super challenging opportunity for all of us trying to move that equipment from A to B or to different locations. So I think it's, in general, very important that we collectively appreciate that ultimately, without those drivers, there's nothing that we can do to move that cargo. Cash in hand, yes. Drivers are getting much aggressive and much better on understanding their own financials. But the challenge is that, again, it's becoming a not enough solution nowadays. Some of them by jumping into the freight side or other segments of the industry are finding more rewarding opportunities. So to bring them back is going to be a challenge too. And the last one, the fourth component that actually hit the mark as one of the major concerns is longer lead times. According to the survey, in Europe and North America, everybody's predicting longer lead times. Yes, in North America, we believe that the rail is going to suffer the most, of course, bigger equipment and more complex to some degree, so we will have to bear with that. But it is really for us the opportunity to help the industry at large and bring in different kinds of solutions to make the supply chain process more efficient. So visibility is super important. Nowadays, we all talk about visibility, and we've been talking about for years already, and we've been talking about sharing data and connecting everything. But in reality is that we all, service providers, depend on the OEM to allow us to connect the entire network. As service providers, we can connect with each other. We RPM, we can connect with other carriers can connect with the rail. Everybody can connect. That's on our wheel. But if we cannot transact on behalf of the OEM and be able to oversee the entire network, it's just very complex. So this is much more a call for help. We want to be able to create a bigger network, but we need every OEM's authorization to do that. Flexible models can help, definitely. We have seen a few OEMs being extremely brave and adventurous, trying new models to distribute product, trying to create opportunities out of these reduced levels of stock, understanding that the old levels of stock that we used to have are not gonna be here anytime soon. So they're taking advantage and they're going from their factory to the dealership or to the final consumer, utilizing different pieces of equipment. I'm saying this with these specific words. They're very brave, yes, because usually this is equipment that has never been standardized. It doesn't fall under the regular standard quality metrics and quality concepts that we have created for the large carriers, but it's still equally valuable. So instead of fighting against that, probably what we should all be doing is finding ways to standardize that capacity and equally use it for everybody that needs it. There's going to be enough product out there for everybody, but definitely there's a need for speed, and that cannot happen if we have to wait for a 9-car hauler to be full or even for a rail car to be absolutely full. We need to keep this in motion. The right providers can increase speed. Well, I think that was very evident. I think that collectively we should welcome the opportunity of new solutions and new tools and put this to the service of the OEMs, which is ultimately the one that is feeding us with vehicles to move. So through today's presentation and tomorrow, the messages are going to be pretty similar. It's going to be very redundant. But I would like just to summarize that all the things that we're sharing, again, are the things that we collectively have expressed as a need. And as we have said in other sessions, it is really the time to get together, to talk about solutions, to challenge status quo, to embrace the fact that there's no product out there as we used to have. So we really need to embrace what I would like to say a much more kind of a just-in-time model where we all can just grab a unit the moment it's ready and move it. The big volumes will come, and definitely at some point we will not be able to catch up with production. In the meantime, we all have to play along. So very, very short. And from that, I guess, Richard, you would like to lead the next steps.
Thank you very much, Sergio. Apologies about the clicker. I think one of the OEMs in the room took the semiconductor out so they could just make one more vehicle, but we'll get that fixed. Gentlemen, please take a seat. And I want to throw it straight out to the audience. If you do have questions, please raise your hand. We have a young man at the back running around with a microphone, so please do get involved, this is your time as well. But I'll kick things off. Brandon, I want to pick up on electric vehicles. Talking about semiconductors, we're seeing the price of raw materials exploding right now, with demand for lithium outstripping supply. Are we on the next collision course for the next semiconductor crisis?
Well, first, let me start off and just say thanks for saying I was overly negative in my analysis. I like to think of myself as a realist, but whatever. Whichever way you want to take it, that's fine. But yeah, I would say there's certainly risk there. We've looked at the increased forecast for those vehicles, again, as I said, driven by the regulatory environment. But yeah, we've got some very real issues, and you've seen some OEMs and suppliers already anticipating that and starting to make moves to secure their supply of some of those rare earth minerals and things. But yeah, it's going to be a struggle. I think this is going to be the first year since the inception of electric vehicles that you've heard me talk in the past about the loaded battery cost, right? The cost per kilowatt hour, and $100 per kilowatt hour being the magic number to kind of be on parity with ICE vehicles. 2022 or 2023, because of those shortages and the increased cost of some of those materials, we might actually see a year-over-year increase for the first time. So that's definitely a cause for concern. And again, the pressure is only going to grow as more and more of those electric vehicles come off the assembly line. So I think it's imperative for any organization that's banking on that or investing in electric vehicles to make sure they take the appropriate steps to the extent possible to secure those supply chains.
Absolutely. And perhaps, sticking with you and sticking with electric vehicles as well, we're seeing huge levels of pre-orders come through when consumer confidence, as you mentioned, is falling, risking going into recession. Is there scope that the OEMs might have to reduce their manufacturing plans, or will this be a chance to perhaps level up inventory levels when these come online if those pre-orders get cancelled?
Yeah, the pre-order thing, especially for electric vehicles, is a little bit tricky, as we've seen in the headlines lately. I think everybody sort of has their own strategy with that. A lot of times, those pre-orders aren't binding or anything like that, right? You put down a deposit, and when the vehicle comes off the line, you get your slot in line to get the vehicle. I don't think that's necessarily an opportunity to increase inventory. As I said during my comments, I think there's a general expectation that electric vehicle inventory won't be as high as ICE, one, because of the shortage of supplies that we've talked about, the relatively high cost, at least in the near term. I do think that some of the lower consumer sentiment that we're seeing right now could help accelerate a replenishment of the overall vehicle inventory. I think that's going to happen regardless. It's just a question at which pace and then how much is enough. And ultimately the OEMs will have to determine what they feel is a necessary supply of those vehicles.
Yeah, great. And Sergio, I want to bring you into the conversation again. Some great insights. I think it's a really powerful message to share those insights coming from the community, from your connections, automotive logistics connections. So it is the industry speaking there. But how are your customers' expectations changing, given what they're going through, given these challenges that they're facing? Please share.
Yes, absolutely. I think, overall customer expectation hasn't changed in regards that every customer wants to have that product delivered, picked up and delivered right away, right a second. What I think is very different nowadays is that the levels of complexity that we're dealing with now are completely different. It's always been an interesting challenge to respond to spot loads, to emergency moves, to expedites. It's always been part of the equation, right? But now it looks like the industry have kind of flipped, and now everything is an expedite. Everything is an urgent matter. But definitely the level of understanding from the customers, I think, is greater in general. Most of the OEMs have been very, very good at minimizing the pressure of the things that we cannot control, or on the things we cannot control, and really focusing on, okay, how do we get the best out of this piece of equipment or that route that you're putting together. So I feel that in general, there's a better appreciation of what is going on at large.
Yeah. And when you're looking for new sort of solutions, new routes to market, how can you yourself, but also the providers, guarantee the same levels of service and quality? You know, when you're looking at potential new models or new methods of working, perhaps collaboration, you know, how can you guarantee that same service level?
So what we're doing, to answer your question, we have focused on improving quality in order to be able to respond to the push from the OEMs. We cannot be responsible and present equipment that is substandard or with drivers that are substandard, to call it that way. So we've been focused on quality, maximizing that piece, trying to apply all what we have learned over the years into that new niche that we're developing and offering that solution. In addition to that, I will say we're absolutely open to work collectively. So we have to share equipment, we have to share routes, we have to share the data that we have in order to then connect with another customer. So we're pushing really hard without disclosing any sensitive information, but definitely at least letting them know we're coming from A to B, you can then get the benefit at B to go to C. So we are pushing for those two things.
Yeah, and you know, is there starting to be an acceptance of that collaboration, that sharing, and is a mindset needed?
I think it's a mindset
needed?
shift, the one that is needed. Again, some OEMs are absolutely welcome the idea. Some OEMs have embraced the fact that the race for sales has nothing to do with the look of the car in the truck. It's about the specs and all the beautiful things on it, right? So some are very welcoming, but some are still struggling with the process, are still believing in the fact that I own this thing, you are supposed to be here to pick it up and do it. So it's very challenging. It's very challenging because then you add all the other issues that we discussed, and then suddenly that potential capacity vanishes again. So it's a mindset shift, I would say.
Yeah, absolutely. And you know, perhaps coming to you, Brandon, on a supply chain being a competitive advantage, you know, is that going to be a key differentiator for the OEMs as the common market forces shaping the business models, the push for electrification? These are all similar strategies that the OEMs are pursuing. So where is those differentiators going to come? Is it supply chain? Is it somewhere else?
Ooh, it's a loaded question, Rich. Thanks for giving it to me. Yeah, I think it's a couple of things. I mean, we saw during the early days of COVID and the semiconductor issues, you did see OEMs that shined better than others in terms of their ability to quickly adapt and handle some of the supply chain issues and maintain production. Obviously, nobody anticipated it was going to continue as long as it did, so at some point everybody kind of ran into similar issues. But you did see that early on, and I would say going forward, hopefully as we come out of this and shift towards electric vehicles, I think it's a couple things. I mean, obviously quality is the expectation across the board. I think customer experience is going to be a big thing. You know, you heard Chris and Steve talk a little bit about the potential of the direct-to-consumer sales and what role that might play in the dealership of the future. But I think it's going to be the OEMs that effectively manage that transition from ICE vehicles to BEV. It's not an easy task, right? Because nobody knows exactly when that inflection point is going to be. And in the meantime, your cash cows are off in your ICE vehicles. So you need to continue to produce those while committing to quickly escalating your BEV share, your BEV production, and manage that effectively, all while keeping the customer happy, who's grown, increasingly frustrated with everything that's happened over the last few years. And then, again, if you look outside the industry, we're talking about I want immediate gratification with things. So it's a tall order, but I think the companies that are able to check all or at least most of those boxes will be the ones that ultimately succeed.
Great. And we're coming up to time, and I'm aware that people need to refuel themselves, but perhaps just sticking with fuel for a last question. Record levels or record fuel prices over Memorial Weekend. You mentioned it's here to stay for a while. Can we expand on that? The impact of the energy rates, the energy market right now, the longevity, how you see that playing out?
Yeah, I think that's extremely difficult question. Obviously, we know what gas prices are doing right now. We know what oil's doing right now. We know why, right? Again, I mentioned what's going on with Russia and Ukraine. That has limited the supply to much of the world for petroleum. So the question is, how long does that last? I don't think anybody wants to put an estimate on how long that conflict is going to last. And so some have said, well, maybe that will accelerate the change to electric vehicles. I don't think so. Again, we talked a lot about the supply chain issues and the ramp-up requirements to get to that point. So it's here to stay for a while. And again, as I talked about, inflation in other areas, I think the only way to provide any near-term relief would be to lower demand for the fuel. And that's, unfortunately going to come at the expense of higher interest rates for other things, less vacations for consumers, less miles traveled for some of the haulers. Hopefully that's not the case, but I don't see any easy relief in the near term. And Sergio, I don't know if you have any other thing you want to add to that.
I don't see any easier relief as well. I think that the biggest challenge that we're facing is precisely the mindset shift that we discussed. Embracing and talking about all these complexities is already challenging enough, but also sharing it with all the audience, or with all the public, with all the community, it makes it even more difficult because are very difficult subjects to discuss, very challenging topics that needs to be addressed. So in between these macroeconomic points, plus the reality of things on a daily basis, I think that it's going to take a while for us to see a real recovery.
And that's not me being negative, Rich, okay?
No.
Just being realistic.
Absolutely. Well, maybe one final question then, and let's finish on a kind of a positive note.
There we go.
So where are some of the key opportunities that we can kind of unpick here?
Well, again, despite all of the struggles, just kudos to the entire industry that we've been able to more or less keep our head above water for the last few years. It's been frustrating and difficult at times, but again, volume's going to increase. We know what the future of the industry is going to look like in terms of, BEV and the added investment in infrastructure and things like that. So there are brighter days ahead. I think we're all just waiting and hoping for that big, relief where it's like, okay, we're unencumbered, we're unrestricted, we can get back to, high demand, high production to get things. And I think Chris said it in his session, we're never going to return to where we were at before, right? The new normal is going to look much different. But there's certainly a lot of opportunities that come along with it. And I think some of the things we talked about, increased efficiencies in the supply chain and logistics fields, more technology, more customer catering, better customer reviews and feelings to the OEMs, the dealerships, the suppliers, et cetera. And then ultimately we're going to be living in a world that has a lot of high-tech vehicles, which hopefully means safer vehicles. And, oh, by the way, before COVID we were talking about more about connected and autonomous vehicles. Maybe we'll get back and talk about that a little bit more as well. So lots of exciting things ahead. We just got to get through the rough patch that we're going through right now.
Yeah, perfect.
I will say that I will echo those comments in general, regardless how challenging it is. We all are recovering. There's better volumes out there. Yes, there's bigger challenges, but yeah, we all are seeing an uptick in production, an uptick in volume. So I think it's exciting. Also to learn how to navigate these in these new kind of methods and these new challenges. Super exciting to be able to bring to the table different solutions and to really be challenged to see if those works. So I think it's a tremendous opportunity for everybody.
Fantastic. Well, I love finishing on a positive note. So, ladies and gentlemen, Sergio Gutierrez and Brandon Mason, thank you very much.